My name is Jake, welcome to the channel. In today's video, I'm going to cover one of the most important topics that there is when it comes to dividend investing. I'm going to talk about investing into growth today and buying dividends later versus just buying and holding dividend growth ETFs and never selling. What does that look like? Things to consider like taxes, rebalancing. I'm going to cover this very complex topic today, and the results may actually shock you and may not be what you're expecting. And I've been reading your comments, and this has been something that's been coming up over and over again, and so I wanted to talk about it today. One of the comments that sparked really the interest for making this video, where the comment was, can you please make a video about the hold and rebalance strategy? Why should young people invest into high yield ETFs when they can invest into growth ETFs like VGT, QQQM? So VGT is focused on technology. QQQM is the, tracking the NASDAQ with an average return of 15 to 20%, and then rebalance in 30 years into high yield cover call ETFs. 30 years of lost growth potential is a lot more than the tax penalty that will result from rebalancing. So yeah, this is a really interesting question. What's going to yield a higher total return despite the tax drag that you're going to have at the later end in 30 years versus paying a higher tax, throughout the 30 years if you're investing in dividend stocks? What could this potentially look like? But yeah, if you're new to the channel, once again, my name is Jake. I retired from my 9-to-5 job last year at the age of 37. I reached what is called barista fire, where I'm living off of my dividend portfolio. My portfolio that you see here on your screen, I invest with M1 Finance, and I invest for income because I'm no longer working my 9-to-5 job. Once you understand what I'm about to share in today's video, I think it's going to open your eyes to a whole new way of thinking when it comes to dividend investing. And once that light bulb comes on, it's like, an angel was sent down from on high, and it could look a little like this. Oh my gosh. What this all comes down to is understanding the rule of 72, how quickly an investment will double. And so when you invest into a stock or, a different companies are growing at different rates. And it's important if you're a new investor that you understand the rule of 72, and that is how long it will take an investment to double. And once you understand that, it'll help you understand the importance of investing into growth and how that ties in to compound interest. Now let's take a look at this beautiful chart here that I put together. I'm going to walk you through it, and I'm going to walk you through the logic so that you can follow along and understand what I'm showing here. So I'm going to blur out certain parts of this so you kind of focus as I explain it, and then towards the end I will unblur it so that you can kind of see the total results and kind of the outcome if you were to buy and hold versus buy, and then sell and then reallocate to, maybe dividend stocks into the future. So we're going to take a look at 3 examples with the following assumptions. The assumption is that you had an initial investment of $10,000 and you were investing $12,000 a year for the next 30 years, and that the dividends are reinvested, but the taxes, you're not paying the taxes with the dividends, so you're paying those with your earned income from your W-2. The taxes are not taken out of the dividends, just to make it simple and easy to follow along. So now that we understand the assumptions, we're going to take a look at 3 examples. The first example is going to be a portfolio made up of the simple path to wealth with dividend investing being SCHD and DGRO. This is going to be a 50-50 split. Now, once again, this is just merely an example. You could do this completely different, but just for simplicity, I wanted to show the example here so that I can make the point here that this is the simple path to wealth. The second example is going to be focused on the S&P 500. Okay. And then the third example is going to be focused on growth, where ideally what will happen with growth is you're going to invest into growth with the parameters above, the assumptions above, and then we're going to rebalance in 30 years and what that could potentially look like. Okay, so that's what we're going to take a look at, and I'm going to walk you through it here step by step. All right, so in the very first example here, you're going to see in the top left that the data here was pulled from January 2015. So we don't even have 10 years of historical data. So I want to preface here, take everything that I'm saying with a big grain of salt. I don't know if this is going to continue, but it's important and fun to run a simulation like this to kind of project reasonably what you could assume. But, to quote Mark Twain, history doesn't repeat itself, but it does rhyme. So if we were to take the weighted average capital appreciation of SHD and DGRO, it'd be about 8.75%. And if we were to take the 5-year dividend CAGR, compounded annual growth rate of the dividend of both of these, it'd be about 10.75%. And this is really important. This is the 4-year average dividend yield. Now, this right here, I take the 4-year average dividend yield because there's really nothing else to work with, guys. I just use this in my simulations just to make sure that it's reasonable. I don't take the forward dividend yield. And if you go over to Seeking Alpha, for example, and if you go under the individual tickers, you're not really going to be able to see the 4-year average dividend yield on ETFs. There's a workaround that you can do, and you have to add them to a portfolio to be able to visualize this. So, for example, if you were to create a portfolio in Seeking Alpha, I believe you can create one for free. And if you want to have multiple portfolios, like you can see here, I have multiple portfolios. You do have to have Seeking Alpha Premium. If you want to try out Seeking Alpha Premium, you can use my link in the description below. You'll get a discount by using my link, but something to consider if you want to play around with this kind of stuff like I do. The way that I get the 4-year average dividend yield for ETFs is I create a portfolio, add them to the portfolio, then you go under dividends, and under the dividends section, you'll see the 4-year average dividend yield. And this has been the average yield of that ETF. And that's usually the number that I will take whenever I run a simulation like this where I'm projecting for future returns. I usually like to take the 4-year average dividend yield, and this is where I got these numbers, and this is how you can do it as well. If you were to look at any other ETF out there, this is a simple way that you can do that. So those are the numbers for the first example for the Simple Path to Wealth, SHD, and DGRO. Next, let's take a look at example number 2 with the S&P 500. The data here that I pulled is actually from 1994, so quite a bit longer because there's more data on the S&P 500. The capital appreciation over the 30-year time period has been 9.65%. The dividend CAGR is not provided on that other website. I had to pull that from Seeking Alpha. I used the 10-year and I got a 6.8% dividend CAGR, and the 30-year average dividend yield has been just over 2%. So much more than 4-year. So I think this number is pretty reliable. I like this number. More data, the better, in my opinion. All right, now with example 3, this is with VGT, VTI, and SPYG. This is going back from January 2015. This is assuming that the portfolio is equally weighted among all 3 of them. The weighted average portfolio capital appreciation is just over 14.5%. This is huge. It's mostly skewed because of VGT. And then the 5-year dividend CAGR is actually pretty low. The 5-year CAGR in VTI is pretty low. But to keep the data consistent, I just use this. I think you could reasonably assume a little bit of a higher one, but I just used what they gave me here. So, and then the 4-year average dividend yield is just over 1%. All right, now that we have the basic numbers for our examples here, now let's take a look at the total return and the portfolio value over the next 30 years. Using the assumptions above, the total return for the Simple Path to Wealth with example 1 is 11.53%. And once again, how we got this was the dividend plus the capital appreciation, right? That is the total return. So when we're projecting the future return, we're using 11.53%. And so if we were to plug this into the compound interest calculator, that's what you're going to see here, $2.9 million over 30 years using these assumptions. Okay, so that's how I got the $2.9 million that you're seeing right here. Now, if we were to do the exact same thing with example number 2 with the S&P 500, S&P 500 has just slightly had a slightly higher total return of 11.75%. The portfolio value would be just over $3 million. And then lastly, with example 3, with a total return of just over 15.5%, your portfolio value with the same assumptions over a 30-year period would be $6.7 million. Next, let's take a look at the dividend tax. Now, the dividend tax is a little bit difficult to calculate, but assuming that, you're at a 15% tax bracket, it's hard to make an assumption with this because there's a few different variables. So I'm just going to make it very, very simple. I'm assuming that you're in a 15% tax bracket using the assumptions mentioned here. Over the 30-year time period, I would assume roughly estimated that you'd be paying about $100,000 in taxes over the course of 30 years with example number one. With example number two, you would pay roughly around $75,000 in taxes over the same period of time. And with example number three, this is just estimated. It's kind of difficult to calculate here, but roughly right around $65,000 in taxes would be, what you would pay over the 30-year period. Now, this could, go up plus or minus, but I'm just using my best guess. So don't hold me to the fire here. It may be off a little bit, but just conservatively, I think these are conservative numbers. So next, let's take a look. If you were to rebalance your portfolio, you were to sell out of everything in the same year, and you'd have a tax bracket, you'd be in a tax bracket of 20%. I'm not saying that everyone would do this. Just for simplicity's sake, let's just assume that you were to do it all in the same year. If you were to do that with portfolio one, you'd pay around $581,000 of your $2.9 million portfolio. Now, the question is would you really want to do that? And we'll get to that here in a second. With example number two with the S&P 500, if you were to rebalance at a 20% tax bracket, the $3 million portfolio, you would pay just over $600,000 in taxes. And then example number three, if you're in the same tax bracket, a 20% tax rate of your $6.7 million portfolio, you'd pay over $1.3 million in taxes to sell out of your portfolio. Now let's take a look at what the value would be of your portfolio if you were to sell out of everything and to rebalance. What money would you have left over after you sold everything? Well, in the first example with a simple path to wealth with dividend investing, you would have, after the tax, you'd have around $2.3 million in your portfolio. With example number two with the S&P 500, after selling and after rebalancing, your portfolio value would be just over $2.4 million. And then lastly, with example three, even though you paid just over $1.3 million in taxes, you would still have just under $5.4 million remaining. So I think everybody can do the math. Everybody can see where you're going to get the most money if you were to rebalance or if you were to sell out of your portfolio. And this comes back and ties into what I was saying earlier, understanding the rule of 72, how quickly an investment is going to grow. Just because you're getting just a few percentage points higher in the total return with this growth portfolio, it can amount to millions over an extended period of time. That is the power of compound interest, okay? So just by having over 4% more total return each year, it can amount to millions and millions over an extended period of time. And this is why you probably see in the comments when people say, hey, when you're younger, invest into growth. This is what they're talking about, guys. If you're young and you have a long time horizon, focusing on growth can be so important. So now let's take a look at the most exciting part, in my opinion, is what it would look like if you were to have this in a taxable account versus a Roth IRA, how the taxes can play here. So now, assuming with example number one, I'm assuming that you're not going to rebalance, because why would you rebalance if you have $2.9 million? Why are you going to want to sell your portfolio just to buy back SHD and DGRO? So I'm assuming that you're not rebalancing. So regardless if you're in a taxable or in a Roth IRA, this is assuming that there's no rebalancing, there's no tax savings in that sense, because you're not rebalancing. You would have a total annual income of around $80,000 in 30 years if you were just to buy and hold, invest $1,000 a month for the next 30 years. As this example. So this is your buy and hold. This is the result that you could reasonably assume in the next 30 years with these assumptions. Now, this obviously doesn't, take into consideration if you were to get a pay increase or if you were to invest more or less over the next 30 years, because this is not likely. It's very unlikely that you're going to invest the same exact amount over the next 30 years. But for the sake of simplicity in this example, it just makes it easier to follow if we just simplify it this way. So I know that this is not going to be reality for everyone, but just so that you can see how the math works, I think it's important to take a look at it from this lens. Next, let's take a look at example number 2. Now, the assumption here is that you're going to sell out of the S&P 500 and you're going to buy in to the Simple Path to Wealth, SHD, and DJRO. And the dividend yield that you would be getting is right here. This is just using an assumption. You'd be getting just under 3%. So if you were to sell out of the S&P 500 and buy in to the SHD and DJRO, what would this look like in a taxable account versus a tax sheltered account? Well, in a taxable account, it's actually going to reduce the amount of money that you're going to have because you're going to have to pay taxes. And you see here that the total return is so similar with 11.5 and 11.75 that after taxes, it's not going to make a lot of sense to rebalance out of the S&P 500 into SHD and DJRO even after 30 years. Because the taxes have such a massive impact on a taxable account, it doesn't make a lot of sense because you're going to get less in dividend income by rebalancing because you're paying the taxes. So in a taxable account, you get just over $67,000. And because in a Roth IRA, you're focused on the portfolio value pre-tax, because you're not having to pay taxes on it, you're going to have a much higher portfolio value than, for example, the after tax. And because of that, if you're doing this in a Roth IRA and rebalancing a Roth IRA, you would actually get more. You would get just over $84,000 if you were to rebalance out of the S&P 500 in a tax-advantaged account like a Roth IRA into SHD and DJRO. Now, finally, with example number 3, if you were to invest into the growth portfolio over the last 30 years with the same parameter, this is where it gets really exciting. If even after paying the $1.3 million in taxes, you're still going to have a larger amount to invest if you were to do this in a taxable account, even after the massive tax drag, if you were to invest the remaining amount into SHD and DJRO equally weighted with an average dividend yield of 2.78%, you'd have just around $150,000 in annual dividend income. Now, this is where it gets really exciting. If you were to do this in a Roth IRA and you were not paying any taxes, let's say you were to keep the $1.3 million, so you're not working off of this in a taxable account, but rather in a Roth IRA, if you had $6.7 million, if you were to sell out of this, the $6.7 million, and rebalance in a tax-advantaged account, pay zero taxes, and if you were to invest into SHD and DJRO, you'd get just over $187,000 in annual dividend income. Well, when looking at these 3 examples here, you can see that the clear winner is example number 3. You're going to get the most dividend income after 30 years by investing into growth today and rebalancing into dividends later. Now, this is the case if you were to invest in a taxable account or in a tax advantage account like a Roth IRA. Example number 3, over a 30-year time period, still outperforms. You'll still get more dividend income at the end of the day. Now, this example, these assumptions are not taken into consideration human emotions. They're not taken into consideration, is the person going to be able to stick with this for the next 30 years? Are they going to buy in and sell out at the right or wrong time? None of that matters. We're just objectively looking at the numbers. And if you understand the rule of 72, if you have an extended period of time, if you have a long period of time, a long time horizon, focusing on growth will yield you the highest total return. And what it all comes down to, guys, is where are you going to get the most income? With that in mind, we don't want to underestimate the power and the impact that emotions can have on human beings when we're investing. Investing is incredibly emotional. Now, have you ever heard that saying, hindsight 2020? Well, yeah, obviously, knowing what I know today, obviously that was the right decision. Now, we're projecting future returns. I don't know what the future is going to hold for us. I don't know if we're going to have 10 years of slower growth and all of this just gets completely shifted in a different direction. I can't tell you that. I don't know. I don't have a crystal ball. And so with that in mind, that we don't know what the future is going to hold, it may make sense to do a combination of both. It may make sense to focus a portion of your portfolio on a buy and hold strategy and another portion on a buy, investing into growth with the intention to rebalance in the future. If you're a long-term subscriber of mine, you know that that's exactly what I do. In my taxable account, because I'm living off my portfolio today, I invest for yield, for income. And so my total return is going to be lower because it's skewed more towards yield. However, if you know my story, you know that in my Roth IRA, I have over 20 years for my Roth IRA to coast in the background. In my Roth IRA, I'm focused on a total return. My largest holdings in my Roth IRA are VTI and VGT, okay? And I do that intentionally because once I reach the age of 59 and a half, what I'm going to do, depending on where the market is, I don't know what it's going to be then, but what I'm assuming is that the value is going to be much higher because I'm investing into growth. And then what I'm going to do is I'm going to rebalance in my Roth IRA and I'm going to pay zero taxes. Okay. Do you understand? And so I personally am doing both. I'm buying in my dividend portfolio, I'm holding it, but also I'm invested into growth. And if you're thinking about what's the right approach for you, it may make sense to do a combination of both or have a balanced approach. It doesn't have to be all or nothing. You don't have to do just everything into growth and nothing into, dividend growth. Like there's many different ways. There's many different paths that can lead to success. It's finding out what works for you and trying to ignore all the noise and people telling you that, no, this is the only way to do it. No, guys, it's called personal finance for a reason. It's personal. You have to find out what works for you. If you were to go and let's say rebalance your portfolio in 30 years, but let's say, you know what, Jake, I don't want to invest into SHD and DGRO. Maybe I want to invest, maybe I invest into that, but I also invest into a covered call ETF, or I invest into maybe a SIN stock or, a higher yielding ETF. And maybe I get a higher dividend yield. Well, okay, what would that potentially look like? Let's say you had a portfolio weighted average of 3.5% after you were rebalancing. What would that look like? Well, if you were to do that, it looks completely different. If you were to have a 3.5% dividend yield after rebalancing, your income, what you see over here, your income would look dramatically different. Now let's take a look at this. Let's bump this up just a little bit more. Let's say, for example, you invest into a covered call ETF, SHD, VYM, and you have, let's say, for example, a 5% dividend yield weighted average across your entire portfolio, which is not crazy. It's not very difficult to get. I have like a 5.5%. So it's not unheard of. What would your income look like with a 5% weighted average dividend yield after you rebalanced? Well, it would look a little bit like this. Isn't that just amazing? With example number one, you'd have just over 145,000. With example number two, you'd have anywhere from 120 to 150,000. And with example three, you'd have just around $300,000 in annual dividend income. I hope that helps you in answering the question, does it make more sense to buy dividend stocks today, hold them forever, or does it make more sense to focus on growth and then rebalance in the future? It's not a one-size-fits-all question. I think it really depends on the person, your emotions. It's hard to discount the impact that emotions have on investing and on us as human beings. And that is why I said earlier, that's why I take a balanced approach. And that is why I do both. I hope that the video was helpful to you. I hope that you learned something new. Thanks for watching.
Please subscribe.
Subscribe.
Please subscribe. Sakar eh?
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.